Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, we are spending the episode focused on one particular market, commodities. It's been a while since we discussed the sector, so we have invited on two experts to join us in a conversation about everything metal and mining. We talk about the commodities themselves, the mines they come from, and the relationship between those mines and the equities that represent them. We talk about copper, we talk about gold, we talk about platinum, and we talk about silver. So in our studio, we have Nicky Shiels, head of metal strategy at MKS PAMP, a group that specializes in precious metals. And in our London studio, we have Evy Hambro, who is one of the world's most influential mining investors. Evy is co-manager of the BlackRock World Mining Trust and global head of thematic and sector investing at BlackRock, as well as being head of the natural resources equity team. Nick and Evy, welcome to Merryn Talks Money. So Evy, why don't I start with you and just tell me what it is that you think of when you talk about commodities? What are we talking about here? How is the sector different to the rest of the market?
Oh, you could go anywhere with that question.
I know. I wanted to have fun by asking at the very beginning if Bitcoin was a commodity, but I decided to leave that at the end.
It's fascinating. If you think about commodities and the fact that we all use them every day, and some of them are more visible to us than others. So if you go to the petrol station and you fill up your car, you know what the price of fuel is and how that changes. If you go shopping at the supermarket, you know what the cost of agricultural commodities are. Because you can see how the price changes. But most of the commodities that we take for granted, the metals and so on, have very, very low levels of visibility in terms of how we consume them. And I think that society as a whole is rather complacent about their supply. And the invisibility of the price changes, and I guess the fact that they're always there and we take them for granted, means that we don't pay that much attention to them. And I think that's reflected in how people value the companies that produce them. And so to us as very, very long-term investors in this space, it's quite disheartening to see how low a percentage of the kind of global market cap commodity producers represent relative to how essential they are, both in everyday lives, but also in sustaining living standards. And it's only when, things go into kind of, panic mode around shortages, or you hit the front page of the media and so on, that people's interest levels rise and, multiples expand, or greed overtakes, fear in terms of people wanting the exposure, that the sector becomes front of mind for most financial investors. And, we're certainly seeing some early signs of that in the government space. But to me, I find it very confusing that something that is so essential to everybody's daily life has such a low level of interest and low multiple that the companies tend to trade on in the market relative to the businesses that actually consume them. I mean, you can't build a data center without commodities, yet the data center companies trade on infinite multiples.
Yeah. And it's interesting. We had a few months ago, we had Ed Conway on talking about his book, Material World, and talking about this difference between the ethereal world and the material world, and the extent to which we've sort of forgotten that the material world is the foundation of everything. And without the mines and without the really filthy, grubby bit at the bottom of everything, we couldn't have all the other things that we like to talk about. It's just interesting how that's happened over the last couple of decades, that the foundations of everything have been forgotten, or the pyramid of need has been rather upturned.
Yeah, I think you're right. I mean, it's a great book that I loved it. I listened to it on one of the players, Audible. It is amazing if you think about how society has moved on through time, where basic industries were such a core part of everything. And now services are the kind of most core part of everything. And it's just, ask how much value does services really add?
Ooh. Controversial. Or can they add anything without the commodity
Exactly,
sector,
that's what I mean, yeah.
And I suppose the other interesting part of that we'll come on to later as well is energy, and this whole just stop oil, etc. palaver, where everyone forgets that in fact oil is part of absolutely everything they touch and everything they feel around them, everything they see is something to do with fossil fuels. But nonetheless, we've moved so far away from the understanding of the material sector. There's a genuine belief out there that the world could continue
Yeah, that's
without these foundation stones.
That's my point about complacency.
Yeah. But you're beginning to see some kind of change. I mean, I think Ed's book was a bit of a turning point for starters, but also looking at the papers this morning, one of the headlines on the front of the FT, competitor alert, was Chinese mining acquisitions globally at their highest level since 2013. So somebody's getting it. The Chinese are out there looking at everything, buying everything, beginning to monopolize as much as they can. So let me just ask you then, when you look at the sector today, what are the parts that you find most interesting? Where is it going to happen that we'll see these supply-demand shocks that are going to wake people up to the importance of this area?
Yeah, I hope we don't have shocks for the wrong reason, because that would be pretty bad for the environment or for safety and life and stuff.
So slow surprises.
Yeah.
Let me go slow surprises.
Yeah, I think it's hard to argue against the fact that the world's going to need more as life goes on. That's pretty much a given. That's definitely been the history, and it's likely to continue to be the future. I think the shape of what more is what's interesting. So when we think about the transition, I suppose, away from fossil fuels, that is a transition from fossil fuels to hard metals, to industrial commodities. And the intensity of use of those commodities rises, almost vertically, the more you move away from fossil fuels up to some long-dated point in the future.
Evy, do you mind if I just interrupt you briefly? Because we always talk about the transition, and when we do, I think it's time we start making it clear that we're not really talking about a transition, we're talking about an addition.
Correct.
Right?
It's just the change of shape and totality.
And I think that's
absolutely.
We've never had an energy transition in history. We've only ever had an addition. So we don't use less coal than we did. We don't use less wood than we did. None of those things. We just use another type of energy on top. And that's what's happening.
Yeah, I mean, we can't have the future that is being advertised to us so extensively without a net addition, because everything that is being advertised, the data centers and AI, just use vast amounts of power. And we can't solve that with fossil fuels alone. It's got to be other things. So the transition is the shape of those energy molecules in terms of where they come from. And through time, I'm sure we probably will get to a point where the shift away from fossil fuels starts to become dramatic, but that's probably quite long dated. But in that transition period, as that part is evolving and becoming a bigger component of supply, more and more metals are going to be needed. And I think that's pretty obvious. So I think that the demand side is very hard to argue with. I think the supply side is equally challenging. We're seeing very, very long dated timeframes of the addition of new supply of industrial commodities. It's becoming harder and harder to develop these things, for whether it's the environmental permitting or the regulations attached to it, the complexity, where these ore bodies are located. They're not kind of shining out of the ground and easy to identify. You've got to go deep underground or top of mountains, and access to water and power and people and kit is just becoming more and more complex. So the thing that we see that's, coming back to your question, that's so fascinating is how the industry finances the growth that is needed. And are the incentives or the returns there today at today's commodity prices to justify those investments? And when you look across the kind of spectrum, it's hard to see the returns for a number of the key commodities to justify that investment. So the imbalance, the kind of shock that you talk about, is probably going to come from a long dated period of underinvestment into supply because the returns aren't there, that coincides almost tectonically with that sudden appearance of demand that everybody identifies, and you then see a price response to reflect that imbalance. And that then triggers probably a long dated period of investment into new supply growth. In that interim period, you've got governments running around, saying that they're worried about security of supply, trying to incentivize investment. You've got the US trying to unblock some of the red tape around investment of domestic resources, which might help. We don't know. It's at very, very early days in that regard. But I still think that the challenges are very much going to be kind of dominating the headlines. And at some point, there's going to be pressure. And that hopefully will lead to improved returns for the companies that make the commodities today.
Yeah, I mean, the demand side all makes sense. And I think everyone can see this. Everyone can see rising demand from the energy transition addition, whatever we're going to call it now, from everyone, from this rising concern about security, from the idea that we should massively increase our spending on defense, increase our spending on reindustrialization, et cetera, et cetera. But when it comes to the supply side, in the old days, we always used to say that the answer to high prices is high prices, or the solution to high prices is high prices, if you see what I mean, because then you get this massive burst of supply. But increasingly, it becomes harder and harder to increase supply for all the reasons that you mentioned, but also for environmental reasons, getting permissions to open new sites, getting permissions to explore, et cetera. So is it the case that as this dynamic you've been talking about unfolds, the cycle is very significantly longer than it might have been in the past? So, for example, all the big companies will now say that it's very significantly cheaper just to go out and buy someone else's sites than it is to try and find another one, explore, get permissions, and get going with production.
Yeah, I would definitely agree with that latter point. Yeah, the valuations on existing production today are much lower than the cost of building stuff. I mean, that's a sweeping comment, but there's a lot of data to support that. And it's not just the cost, it's the time and complexity, as you mentioned, about building new stuff. So you might have a project that's ready to go, but it still takes many, many years to construct. There's still a lot of risk around how much it's truly going to cost. Anyone who's built a house knows that it tends to cost more than you think at the start. And it's the same with building a mine, except the numbers just have many more zeros. When you think about that, if you're buying an asset today that's in production, you've got many, many years of cash flow from that asset before the stuff you might be building from scratch actually starts producing cash, if it starts on time and at the right cost and ramps up to full production successfully. We've got a few examples recently where some of the world's biggest new copper mines have ended up costing 50 to 100% more than originally planned and are still not at full capacity 2 or 3 years after having supposedly started. Whereas if you'd gone and bought somebody else's asset and paid full price for it, you would have had 3 or 4 years worth of cash flow to help reduce that cost by the time the new one might have started. So I think that kind of on a risk reward basis, the assets in the market are trading a lot cheaper for less risk than building things from scratch, which obviously is one of the opportunities in the market that we see.
Okay. Nicky, we've talked a lot around commodities in general and about the different metals. I know you specialize particularly in precious metals, but in the world of metals overall, are there any that you look at and you find particularly interesting? We're not going to go straight to gold, by the way.
No, you talked about these, not to build on this, and sort of pun intended there, but you talk about the slow surprises. And when you look at commodities, sort of you go supply minus demand, you kind of fudge for macro equals price. And gold it's less of a commodity out of all of them. But from my seat, basically what we're seeing is platinum is really turning into PGMs, turning into sort of that slow surprise. We touch on again, it's structural years of underinvestment in the sector. A couple of months ago, 50% of your supply was underwater. And so you sort of have this sort of, really low pricing regime, a sort of painful period. And you then get a catalyst, which happens to actually be the gold price, because Chinese jewelry demand is basically down like 30-40% given high gold pricing. And so you got your Chinese jewelers really looking at restocking and going into platinum versus gold. So that is the catalyst that has, seen a almost 40% repricing in the last few weeks, which is pretty unprecedented. So yes, eyes are definitely on the PGM sector, because again, I think that response, and we talk about the supply response and how quick that is, because when demand does turn, it can turn pretty quickly. And in metals, it's either scrap or it's primary. And if there's just no mine to build, right? It's just not there. And scrap, especially for PGMs, it's sitting in order cats. And people are just hanging on to cars for longer because of high inflation, because of uncertainty, because of tariffs, and that material just isn't coming back. So we're not really seeing that supply response that you generally see across the metal space, industrials, and precious when you get a large price re-rating.
Okay. Well, I'll tell you what, I give in. Let's talk about gold. It's interesting, Evy, your portfolio is 30% odd in gold equities at the moment, right? And Nicky, I know you're something of a gold bull, right? Nicky, why don't you talk us through the case?
I think gold sort of speaks for itself in terms of its re-rating through 2000, and it is putting commodities back on the map in the broader sense. It hasn't burnt itself out like every other commodity price boom or bust. So you've got investors coming back and saying, right, is this time really different and why? And you've had a bunch of structural forces come together. deglobalization, de-dollarization, which didn't start now. This started Brexit. This started Brexit. Trump 1.0 accelerated with COVID, accelerated with the Ukraine war, the weaponization of dollars, and then just sort of ongoing geopolitical tensions. And I think you now have a world where, protectionism is up. And again, it calls for those strategic stockpiling and central banks have been that key game changer, that a key demand game changer for gold, whether it's a sub $2,000 asset or now $3,000 plus asset. And the way they're accumulating just as a dollar hedge, but also a fiat currency hedge, an inflation hedge, and a geopolitical hedge is kind of unprecedented. And we don't see that falling away anytime soon.
You don't see it falling away anytime soon. The Chinese government, Chinese central bank, for example, has been buying and buying and buying, and you see that continuing.
Mostly, yes. So it's mostly emerging markets, central banks, a lot of African, a lot of Asian, obviously China. The interesting thing is, World Gold Council do a great analysis and data on central bank buying, but it's official and a lot of it's unofficial. And in a Trump era, Trump has actively come out. He had comments overnight related to the BRICS summit. But if you're actively seeing de-dollarizing, which in the purest form is accumulating gold, the threat of tariffs increases. So I think you're going to see a lot more. It's going to become a lot more opaque. Back to what we started off on the conversation. I think central bank buying, you're going to have a lot of unofficial or just estimated central bank buying, and it won't go through the official channels.
Okay, interesting. Evy, is that what you see as well?
I think I'm more bullish than that. I agree with a lot of the comments made, but I just think the scale is just so much greater. You look at the size of government balance sheets today, and I think that the education, a painful education that many people have been through about the loss of purchasing power over many, many years. Every year, your paper currency buys you less than it did in the year before. And, cumulatively, it's very, very expensive for paper assets. And I think the scale of government balance sheets now that need to be continually refinanced, people have learned a very, very expensive lesson. We did a study of a year ago or so. I think the iPhone is now 16 years old. When it was launched, it was $500 for an iPhone. Now it's $1,500 for an iPhone. If you use gold to buy your iPhone, you need 34% less gold today to buy today's iPhone than you did when it was first launched. That is the protection of purchasing power. Real assets have held value much better than paper currencies over time, and we all know that. And I think that people have started to become educated. Central banks have certainly become educated on this. And so my career is too long now, but when I started in the 1990s, everybody had an allocation to gold in an investment portfolio. In the early 2000s, that allocation was zero. Even the Swiss wealth managers had zero allocation to gold. Now it's getting back to 2-3%, some cases more. Central banks have stopped selling gold in the early 2000s. Having had whatever it was, 4 decades of net selling, and they've been buying continuously, and they're buying at twice the average rate, or nearly 3 times the average rate over the last 3 years relative to the last kind of 7 or 8 before that. So we're at a kind of a pivoting moment in this where gold has really reestablished itself as a financial asset.
You make a really good point on the allocation to gold and the relative size, I think, is of the gold market relative to other industries, I think is underappreciated. So yeah, it's just that idea that the gold space relative to the questioning of U.S. treasuries, questioning of other assets, it can't hold the amount of allocations if we simply just doubled investor allocations, or if central banks just had to double their allocations to the sector.
So what percentage of an ordinary person's portfolio should be in gold, Nicky, do you think?
World Gold Council, the numbers thrown around is about 1 to 5%. I look at a very crude measure of just known investor holdings, which is just simply ETF and your net COT numbers, and that's less than 1% as a percentage of equity holdings. But I do think specialists are somewhat involved. this is what makes me extremely bullish. There's no gold rally that's firing on all cylinders. Retail's pretty sluggish, both in Europe and in the US. You've got central banks, you've got general investors, but I think it hasn't got to that FOMO level where the New York taxi cab is talking to me about buying gold. So really has been a sort of cold-hearted, sort of allocation, very measured allocation to gold.
Yeah, I'd go more than that. So, yeah.
I thought you might say that 5% wasn't anywhere near enough. What would you go?
So I think there's two components to that answer. The first one is that there are different ways to get exposure to gold. And to me, the optimum way is to have a mixture of exposure to physical and to gold producers. And so you set yourself a target where you want that exposure to be, and you might go with 5%, you might go with 10. I normally have anywhere between 15 to 20% in my own personal portfolio. And, you manage the risk of those two positions. So if gold outperforms gold equity producers, then, you take a few profits in the physical gold and put it into the gold producers, and you just manage that exposure in time. But you manage it as a number. So, if it gets too high because something's outperformed, so the gold shares are up 3 times the gold price this year, you obviously be taking some profits in some of the gold producers and putting it back into physical if you think they've gone too far. You mentioned our exposure to gold equities in the portfolio today. We went from an underweight position in gold producers at the beginning of 2024 to a substantial overweight position in the gold producers, not because we had a different view on gold price. We've been bullish throughout that period. We just felt that given the move in the price, the companies were set to earn an extraordinary amount of cash flow and profits. And therefore, we couldn't argue with that. And even the worst companies couldn't destroy the profitability that they were now getting. And so therefore, we adjusted the position because there was value in the producers over the gold price view. And we're maintaining that. We've got a very, very healthy level of gold equity producer today because we think this quarter's earnings, second quarter of 2025, should be the evidence point, a little bit like the homework being marked by the master. We will see whether the companies have been able to hold on to the price moves and convert that into cash. And the results over the next few months are going to be a real test for these companies. And then the second element of that test is what they do with the money. Do they waste it, which is too often a track record of management teams, or do they give it back to shareholders with higher dividends? A lot of them are embarking on share buybacks. Most of them have paid down their debt. So there's a lot more choice about what they can do because they're not restricted with debt covenants and so on. So we actually think we're on the cusp of quite a material change in gold producer valuations if they can deliver. And when you look at the valuations relative to the past, they're trading way below their own historic levels. So there is a lot of room for them to move despite the year-to-date returns that they've been able to mark up. And then coming back to that question about the allocation, gold is also a risk tool, but also an insurance policy. Take Nicky's number of 5%. The other 95% goes really, really well. Take some profits out of that and add back to the gold to keep it at that 5% number. And you will be absolutely thrilled when the 95% has that unexpected fall that 5% over delivers for you and acts like an insurance policy. And I think that's how you measure it. You don't chase gold because that is the big mistake. If you're chasing it because you think it's going to go perpetually higher, you're probably going to be disappointed and probably buying at the wrong point. But if you're managing it as part of an asset allocation in your overall portfolio, that is the sensible and smartest way to do it.
Yeah. Can I ask you what the top gold holdings in your portfolio are? What are your favorite miners, producers?
Well, we move those around. So we don't necessarily have a particular favorite name. What we do is we try and build that kind of basket of exposure. So because not every company can offer to us what we want. So some of them we own for cash flow production. Some of them we own for exploration potential. So they're going to discover more. Others for growth in production. Others for stability. You've got to build your house on strong foundations and so on. So it's getting that mixture right. It's like baking a cake. If you're only interested in the flour, the cake's not going to taste very nice. But if you want to mix it with the right ingredients, then you're going to end up with a good outcome. So we think that kind of blended approach, it works well. It also softens the risk. So if you have all of your exposure in one particular name, then you can tend to be disappointed by that.
Nicky, what about silver?
Silver, it's along the lines of platinum. I think, like I said, gold has put precious metals back on the map as a sort of general debasement trade. And I think silver and platinum are obviously coming into that forward as kind of the second iteration of that general debasement trade. We had it at a $30 to $35 range. It's now moved up It's still relatively cheap if you're talking about gold consistently hitting all-time highs. It plays the dual part, right? You've got industrial demand, which is still super, super strong. A lot of it is PV, but again, as electronics, it plays a part in the transition economy. And then as well, it's got that investment side. So to me, silver, if you think we are right now sort of at a macro inflection point where we're going to get sort of a series of trade deals. The Fed is going to join the G10 rate cutting party. The US dollar has depreciated a ton, but it's still in its early innings of a sort of structural decline. Then your high beta, more industrial precious metals such as platinum and silver definitely have more upside than gold. So in terms of, it's just we're not really in that full-on fear mode where havens are being overbought, and I think there's a rotation out of sort of your pure havens into some of these alternatives.
Eva's nodding away like he either completely agrees or has something to add.
No, I think I find silver fascinating. I started my job and take some photographs, take the camera film to the chemist and get it developed. And, that was silver. Silver was 40-odd% of demand was photography. And when was the last time you took a film to the chemist to get it developed, if you can find one that would do it? So, silver has that amazing ability to kind of reinvent itself with regards to demand. And today it's attached to that really, really fast growing part of the market, which is solar cells. And it's the biggest part of consumption. So as that grows and the world uses more, it's great for silver. Silver also has this other characteristic where there aren't very many pure silver mines. So it tends to be a byproduct of production of other commodities. So you have a copper mine that might produce some gold and silver at the same time. And so the kind of cost of production element doesn't apply as kind of neatly in relation to other commodities. The oil price falls below the cost of production shuts. Same with copper and other things. Silver doesn't necessarily have that same extent because of that byproduct nature. And so the kind of supply side support on price from a kind of cost curve isn't really there to the same degree. So we actually are very positive on silver. We think the silver equities have been left behind. We think there is room for a more material move in the price of silver. We're actually surprised that it hasn't broken out. It's had a couple of attempts recently in that kind of mid-30s range, as Nicky mentioned, but we haven't seen that kind of big bump move yet. So we're kind of anticipating that. So in our Golden General Fund, we've actually got an active weight to silver today that's pretty big because of that positive view.
Oh, good. I'm glad to hear that. I've been holding that Golden General Fund for decades at this point.
Well, it's at an all-time high now, Merryn, so you should be pretty happy with the...
I know. Yeah, there were some not so happy days.
I totally agree. We've been through a bit of a roller coaster across all the commodity space, and the Golden General Fund's been one of those. But no, I'm very pleased to see 22 quid or whatever the unit price is today.
Yeah, me too. Nicky, outside precious metals, are there any metals that you're particularly interested in? I mean, obviously the big one out there is copper, and I'll come back to you, Evy, on this, the big part of your portfolio. But is that interesting to you, Nicky?
Yes, I mean, it's definitely interesting, sort of fits that similar framework with platinum and with silver in terms of if you're looking for a reflation trade, again, these are metals that are generally constrained. You have a strategic stockpiling globally occurring in critical metals. And so, yes, I think do like copper, constructive and positive to it, but yeah, I'll probably add that in industrial metals. We like some of the OPGMs. Ruthenium is really a big part. Again, there's no listed commodity that's very niche. It's basically, I call it the NVIDIA of the PGM sector, but it's a big part of sort of data centers. And again, the South African mining complex, I mean, they can't mine these metals in isolation. It's mined as a basket, similar to what Evy was referring to in silver, as in their byproducts. So, yeah, generally constructive.
Yeah, it's interesting. I mean, going back to that, I mean, we read so much about the rare earth metals, which, as we all now know, aren't exactly rare, but only mined in particular places. How does a retail investor get exposure, Evy, to the rare earth metal story?
There are a handful of listed companies around the world that you can get exposure to. The quality of the assets is very variable. The challenge with the rare earth space is, there are lots of different elements to the supply chain. So it's not necessarily the mine. It's downstream from that. It's the processing and conversion of that, of those products into usable items. And it's that element that China controls. So China controls that intermediary step between the raw production and then conversion into something that's usable, and then the sale of those into other formats, whether it goes into magnets or other applications. And that's the kind of huge strategic win that China's had over the years. They've realized that if they can dominate the control of the supply of that. They don't need to own the mines as such. They just need to own that intermediary step. And that gives them that long-term power base. So you've got to think about, where is the margin made? Is the margin made in digging the stuff out of the ground, or is the margin made in converting into something that's usable? And that's where you need to think about your exposure. So we do have exposure to rare earths across our portfolios. Some of them are in the mining companies. We have 2 pure play exposures, both listed in Australia, where one is exclusively a rare earths producer, and the other one is building out a rare earths facility, both downstream processing and the mining of the product. So, and that will come into production in the next kind of year and a half. So those 2 companies are our kind of ways of playing it. We haven't gone into the kind of more exotic ways of doing it, because it's just a bit of a challenge, that some of those companies, but that's how we're doing it.
But you should see an awful lot more of the mining and the processing of all these commodities coming back into Western countries, right? I mean, that would make sense if everyone is concerned about energy security in particular. We're going to have to mine and process on our own land, which is a grubby thing to do. And we don't like doing these things because they're all dirty, and we prefer to outsource all the dirty work to China in particular. But we're going to have to bring it back on shore.
Yeah, there's definitely that. And I agree with what you've said. But the challenge is the price. At the moment, the prices of these things are not high enough to justify the investment to build that onshoring of capacity. I mean, nowhere near high enough. If you look at the share prices of some of the rare earths producers, they have not been good performers at all. In fact, they've been completely the opposite. And that's because China doesn't want that supply built. They like the fact that they control the industry. And so the last thing they want is to lose that kind of 80+% market share position. So it will require some incredibly low cost capital or huge grants and subsidies or whatever from Western world countries to be able to build that, plus some changes around the regulation, I suppose, in terms of the processing capacity, because it isn't the cleanest of industries. It will take some change, and that change will take a lot of time. So I think the supply side response is relatively inelastic in the near term.
Yeah, although I suppose it is possible, and we've talked a lot on the pod over the last couple of months about the muted rise in defence spending. And if you're going to be spending 5% of your GDP on defence, what are you actually talking about? And the answer, of course, is that you're not really going to spend 5% of your GDP on tanks. You're going to spend it on exactly that, providing low-cost capital or very large grants to securing your supply of the metals and minerals that you need for energy security as well as physical security, yeah?
That's definitely going to form a large part of that. As you say, you're not going to be necessarily building the tanks. You're going to be building the drones. And the drones might use that much steel, but they will use a hell of a lot of magnets and chips and so on. And then you've obviously got the explosives and everything else that goes with it. So the shape of spend is going to be different to the past in defense.
Do you hold any renewables equities, or is that outside your remit?
No, we got a large renewables listed equity business on the team, and that's actually going through a bit of a renaissance right now. I think everything that was talked about in the context of sustainability, has been through a bit of a downturn over the last few years, and it's kind of reached that kind of low point where things are starting to change. Obviously, the shift and the backwards and forwards in the US with regards to regulation there looks as though it's reaching a point where it's going to be less bad, and the equities are starting to kind of reflect that. So our exposure there is really starting to improve. And I think when you look at the valuation of those businesses, they've been so heavily penalized now for the last 3 or 4 years. It's kind of hard to see them go any lower. So I think there's actually a very good opportunity in that space.
Hard to see them go any lower is not the same as being able to see them going up.
No, I think they've gone so low that the next move is up. And I think it goes back to that question we were talking about earlier on, or the topic around the energy transition. The only way to fill the energy needs in the near term, in terms of extra molecules, is by adding renewable capacity. And so the growth that's going to come through from the deployment of money into building out the renewables is going to be the solution. I mean, try and get a gas turbine, and how long it takes to get hold of that. It's super, super hard. Reactivating the nuclear, which we are very optimistic on, for the outlook for uranium, is definitely coming. But boy, it's going to take a long time. And so unless you're going to build a whole bunch
But does it have to take a long time? I mean, we have talked about this quite a lot on the pod about uranium, and I would love to know Nicky's opinion on uranium in a minute. And with that, we talk about the energy mix endlessly. We must have this mix of different sources, etc. But do we really, really need an energy mix? If we actually went full on with nuclear, if we really focused on SMRs, if we put up new nuclear plants at the same speed as the South Koreans, for example, which is very significantly cheaper than the way we do it in the UK, and you can get them up in 5 years. If we did that, we could solve all our problems in a relatively short amount of time. It's not that it's not possible, it's just that we won't do it.
Yeah, I agree with you. And you mentioned the UK, and obviously the disaster of Hinkley Point in terms of its cost springs immediately to mind. But you also said 5 years. You can build a hell of a lot of data centers in 5 years, much quicker than you can build the nuclear, even at the SMRs.
It takes you 5 years to put up a whopping great wind farm. It takes you 5 years to get planning permission for a solar farm. 5 years is nothing in the world of the UK's planning permission. If you decided to solve your problem, you could solve your problem very fast. Like everything in the UK, our problems are easily solvable by policy changes. I'm sorry, I'm way off into politics now. All of our problems are solvable with fast, sensible, data-driven policy change. We're just not mad for it. Anyway, but be that as it may, you must have exposure to uranium in the portfolio.
We do have exposure to uranium in the portfolio, and the uranium side is really interesting. If you talk about a commodity that's had zero investment in for an incredibly long time, some of the world's biggest mines were kind of put on care and maintenance because the demand was just so bad. And they're now being reactivated because the demand is coming through. The restocking cycle is very, very long dated. And what's interesting is, I think it was 2 years ago now that we attended a conference here in the UK for the uranium companies. And it was a little bit like the kind of mating season where the uranium companies meet the utilities and they work out what their needs are and so on. What was fascinating is meeting with the uranium producers who are now having, requests for supply coming from technology companies, because the technology companies had worked out that one of the challenges was power. And if they needed to solve the power, they needed to solve it with long-dated, low-carbon, reliable baseload power, and nuclear was the solution. So they were actually pitching direct to the uranium producers for access to units of supply to be able to meet their future needs. And then 2 weeks later, we saw the announcements about the reactivation of capacity in the US. And so this is absolutely moving forward. And it wouldn't surprise me that we see more growth coming out there. But again, it's going to take time.
So we should all hold Cameco.
We do have that in the portfolio, absolutely.
Let me ask you about the future. So we're going to have a lot of mining companies out there. We talked about gold companies in particular. There's going to be a lot of cash piling into them. So we're going to see a lot of companies in this sector, massive amounts of cash on their balance sheets. What do you think they're going to do with it?
What I think is going to happen is different to what I would like to happen. And I think what I would like to happen is that the companies are disciplined. They give returns to their shareholders who've invested in their businesses, and they manage those cash flows sensibly and investment in the right way. That's what I hope will happen. What I think will happen is that the companies will repeat what they've done in the past. Not every company, but I think we are seeing today a rise in capital expenditure across the industry with questionable returns. And I am worried that this is a trend that might come back to levels that we saw in previous cycles. Why I'm worried about that is because a lot of money was destroyed when companies were generating great margins because of poor thinking and capital allocation. And I really hope we don't see a repeat of that. It's a message we're trying to get through to the companies as frequently as possible. Absolutely, there are companies out there that will not do that, and they will be disciplined, and they will be great businesses, and we're really happy shareholders in those companies. And if the companies can be disciplined and return the money, then the shareholders will do very, very well. The host nations will do very well. The employees will do well. Good taxes will be paid, and the shares should re-rate. The risk is that they don't, and the opposite happens.
And we don't get those dividends we've been looking forward to.
Yeah, and the gold companies are great. I mean, my old boss was a wonderful man called Julian Baring, and he was absolutely table-thumpingly strong on this topic. He was the kind of the great creator of this, of investing in this in the gold space, and he would always hold companies to ransom with regards to dividends, and because they are a fair way of sharing the spoils that the companies make, and they're a great discipline too. If you don't do a dividend because you badly invested the money you're making, then you owe your shareholders an apology. And so a discipline around dividends is like handcuffs on management. If you know the dividend is sacrosanct and you've got to pay it, then that reduces the amount of free money that you have to reinvest, which means you can therefore only make smaller mistakes if you're going to make mistakes. And so dividends are absolutely essential component of returns. And if you look at the industry as a whole, through time, the mining industry, greater than 50% of the returns that the industry generates are dividends. Yeah, and if you're not paying the right amount, then you're really going to let yourself down.
Okay, we'll keep an eye on that. Let me just ask you one last question, both of you. Nicky, do you see Bitcoin as a competitor to precious metals?
We look at M2, you look at liquidity in the system, like global liquidity is consistently reaching all-time high. There is a space, this is a space where both can survive. They basically complement each other, Bitcoin and gold. They shoot from the same hip in terms of what they kind of stand for, anti-fiat, so sort of a vote against the system. But one is extremely volatile, the other one is a bit of a more safe haven. So I think in a portfolio, there's enough space for both of them, depending on your risk profile, depending on what you're looking at. So I don't really see it as a competitor in a world where there's a consistent search for US dollar hedges. And there's a dearth of reliable US dollar hedges out there.
Yeah. Okay. Thank you. And Evy, would you put it in? I mean, is it a commodity? I mean, you mine it, right?
Yeah, I would say a miner would argue with that. I think it's a word rather than an action. Crypto as a whole is sold on the same basis as gold, and Bitcoin in particular. And as a result of that, there are characteristics that you could see, in a similar light. I think gold is the original. Gold will be around for thousands of years, as it has already been around for thousands of years. I think it's re-earning its place in people's portfolios with the moves that it's had. I look forward to the day where you are able to pull out your debit card and spend gold. I think that's a really, really exciting time. I know there are some companies that are doing that already, but it isn't mainstream in the same way that you pull out your card and you can swipe on your phone to spend euros or dollars or pounds or whatever. Why can't you swipe to spend gold?
I have the answer for you there. I have the answer for you to that question. And the answer is capital gains liability hell. Not if your gold exposure is held via coins, because there's no CGT on gold coins. Okay, fair enough. So you've got coins backing up your card.
Correct.
This is too complicated. We're going to leave it here. Evy, Nicky, thank you so much for joining us today. Hugely appreciate it. Listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending your questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi, Moses Andam, and Hala Ahmadi. Sound design by Blake Maples. Special thanks to Nicky Shiels and to Evy Hambro.